Heading into the second half of 2024, it is important to understand the forces driving the financial markets. In this episode, we uncover insights and key takeaways from our mid-year investment outlook report. In the first half of this year, a major unexpected development has been the evolving expectation for interest rate cuts by the Fed. The timing and magnitude of the cuts have shifted dramatically, largely due to a higher than expected inflation reading in the first quarter. That said, we are of the view that while it may be slower to descend to the Fed's 2% target, the disinflationary trend remains intact. Therefore, while cuts may be delayed, they are not derailed. Artificial intelligence has been in the spotlight as a significant investment theme, with Nvidia leading the pack and gaining nearly tenfold from the lows seen in 2022. As its CEO suggests, this is only the beginning. The next frontier is to move from digital media to the physical world of robotics and fully autonomous driving. The widespread deployment of generative AI will require substantial infrastructure investments, particularly in modern data centers that demand significant electrical power. Looking ahead, AI is poised to trigger a broad-based investment cycle spanning many industries and companies beyond the few obvious winners so far. Geopolitical tensions between US and China will drive risks for some, but present opportunities for others. Countries in ASEAN and Mexico are potential beneficiaries of the ongoing Sino-US tensions and rebalancing of the global supply chain. So, what does all this mean for investors? Our mid-year investment outlook report concludes with several key investment strategies. We maintain our overweight in equities given the reasonable growth outlook and expectation for lower inflation ahead. We believe in Europe, Japan, and Asia that are geared to the industrial sector and global manufacturing will be well supported. China remains a valuation call, and while policy stimulus remains piecemeal, the cumulative impact may become meaningful over time. Foreign investors are still lightly positioned on Chinese risk assets. Their fund flows could return as growth becomes incrementally positive. Fixed income investments continue to play a crucial role as portfolio stabilizers. For investors seeking yield, the current interest rate environment could be used to build longer-term income and cash flow. Allocation to less correlated alternative assets, including hedge funds, private assets, gold and commodities, is also recommended, considering infrastructure build-out, general supply shortages, and episodic geopolitical flashpoints. As the convergence of the Fed policy, shifting geopolitics, and AI continue to shape financial markets going forward, portfolio diversification remains as a critical investment discipline. Thanks for tuning in. For more insights, please speak to your senior client advisor.